Well, our industry went through a long recession, and I'm speaking about life insurance, not property casualty when I said that. Low interest rates stifled investment. The demographics, in some sense, worked against people wanting to buy insurance as we worked through the baby bust births in the United States.
I don't know that they've surprised me. I do think there are a couple of things that are worth pointing out. I think that in North America, one of the things that we have seen is an awful lot of reorganizational activity taking place in life insurance companies, particularly large ones. And I think the realization that some of the threats about market changes and demographic changes are coming home to these carriers in a realization that they may need to position themselves differently for the future. I think we've lived in a protracted period where the economy has been relatively stable in terms of growth, which is a positive thing. But at the same time, we've lived in a period where the interest rates have been generally low. And so for carriers, that's created some challenges because of the lack of investment return that they may have had on some of their more fixed income portfolio elements. And those investment returns have historically allowed them to deal with overages on the expense side or variances from what they might have expected on the mortality and morbidity side. I think the fact that that's not an offset right now is leading carriers to fundamentally rethink some of their economic positioning. And we're seeing, I think, a renewed focus on how to improve the economic performance inside some of these companies.